10 rental property tax deductions you need to know. Some of the best tax benefits in the US are designed specifically for real estate investors. These tax breaks are so powerful that some investors can reduce their tax bill just by using them correctly. While other businesses pay taxes on all their profits, rental property owners get to take advantage of deductions that lower their taxable income, meaning you keep more money in your pocket. However, not all real estate investors take full advantage of these savings, maybe because they're not aware of which rental property tax deductions they qualify for. So in today's video, I'll walk you through the most important rental property tax deductions that can help you save thousands on your taxes. So if you are already an owner of a real estate, or if you're thinking about buying real estate in the future, then this is a video that you don't want to miss. All right, let's get into the top 10 tax deductions that every rental property owner should know about. Let's get started. 1. Mortgage interest. If you have a loan on your rental property, the interest portion of your mortgage payment is 100% tax deductible. For many investors, this is one of the largest deductions available. This includes mortgage loan interest, home equity line of credit interest, and more. Real estate investors often pay thousands or even tens of thousands of dollars in interest each year, making this one of the most viable tax deductions. How the mortgage interest deduction works. When you make a mortgage payment, it's typically divided into principal, the amount that reduces your loan balance. This is not deductible. And the other portion is the interest. The cost of borrowing money, this is 100% deductible. Since rental properties are considered businesses for tax purposes, the IRS allows you to deduct all interest paid on loans related to your rental property. Example, mortgage interest deduction calculation. Let's say you have a rental property with a $300,000 mortgage at 7% interest. Your monthly mortgage payment, which is principal plus interest, is $1,996. The interest portion of your payments for the year is $21,000. You can deduct that full $21,000 from your rental income, lowering your taxable income significantly. Where to report mortgage interest on your tax return? To claim the mortgage interest deduction, you need to file Schedule E, which is used to report rental income and expenses. Your lender will send you a Form 1098 mortgage interest statement at the beginning of each year. This form shows how much mortgage interest you paid in the previous year. 2. Property details. List the property address, type of property, single family, multi-unit, etc., and other details. Other loans that qualify for interest deduction. Besides standard mortgages, you can also deduct interest on home equity loans and HELOCs if used for rental property improvements. Private loans if you borrow money from a private lender for your rental. Credit lines and business loans used to acquire or maintain rental property. Why this deduction is so powerful, there's no limit on rental property mortgage interest deductions, unlike personal home loans. This applies to multiple properties. You can deduct interest on all rental mortgages. 2. Depreciation. Depreciation is another important tax benefit available to real estate investors. Even though rental properties often increase in value over time, the IRS allows you to deduct a portion of the property's cost each year, as if it were losing value. This creates a paper loss, which reduces your taxable income without costing you any actual money. How depreciation works. The IRS assumes that a residential rental property has a useful life of 27.5 years. For commercial properties, it's 39 years. Example, you buy a rental property for $300,000. The IRS says you can't depreciate the land itself. So let's say the land is worth $50,000 and the building is worth $250,000. The annual depreciation deduction would be $250,000 divided by 27.5 is around $9,090. So each year you get a tax deduction of $9,090, reducing your taxable rental income. Depreciation recapture. The catch to watch out for. When you sell the property, the IRS may recapture some of the depreciation deductions you took. This means you might have to pay taxes on the depreciation you claimed at a maximum rate of 25%. However, many investors use 1031 exchanges to defer these taxes indefinitely by rolling their profits into a new property. 3. Repairs and maintenance. When you spend money to fix or maintain your rental property, those costs can be fully deducted in the same year you pay for them. These expenses help keep the property in good condition but don't increase its value long term. Examples of deductible repairs and maintenance: fixing a leaky faucet or clogged drain, patching holes in the walls and repainting, replacing a broken appliance like a fridge or stove, repairing a damaged roof, minor patching, not full replacement, servicing the HVAC system or fixing a broken water heater. Repairs versus capital improvements. Not everything is an immediate tax write-off. If an expense improves the property, extends its life, or adds value, it's considered a capital improvement and must be depreciated over time instead of deducted at all once. Examples of capital improvements: must be depreciated, replacing the entire roof instead of just patching it, installing a brand new HVAC system instead of repairing it, remodeling the kitchen with new cabinets and countertops, adding a new room or extending the property. Repairs and maintenance reduce your taxable rental income right away. Keeping track of these expenses helps lower your tax bill every year. So, by understanding the difference between repairs versus improvements prevents IRS issues. 4. Travel expenses. If you drive, fly, or stay overnight to manage your rental property, those costs can be tax deductible. The IRS allows you to write off travel expenses as long as the trip is directly related to your rental business. What travel expenses can you deduct? Mileage and gas. If you drive to check on the property, meet tenants, or supervise repairs, you can deduct standard mileage rate set by the IRS each year or actual expenses, gas, maintenance, insurance, etc. Flights and hotels. If you own a property out of state and need to travel to manage it, you can deduct airfare and lodging, rental cars and public transportation, any taxis, Ubers, or rental cars used for property-related travel, meals, partial deduction. If you travel overnight for property management, 50% of meal costs are deductible. Important rules for travel deductions: keep records, track miles, receipts, and trip details. No commuting deductions. Driving from home to your rental doesn't count unless it's a separate business trip. 5. Property management fees. If you hire a property management company to handle your rental, the fees you pay them are 100% tax deductible. What property management fees can you deduct? Monthly management fees. Most companies charge 8 to 12% of the monthly rent to handle tenant communication, rent collection, and maintenance. Tenant screening fees, background checks, credit reports, and application processing costs. Leasing fees, charged when the company finds and signs a new tenant. Maintenance coordination fees. If the management company handles repairs, inspections, and maintenance requests, those fees are also deductible. Eviction costs. If they assist with evictions, court filings, or legal paperwork, these expenses can also be written off. 6. Legal and professional fees. If you hire an attorney, accountant, or a consultant for your rental business, their fees are fully deductible. This includes setting up an LLC, creating a lease agreement, or getting a tax advice. What legal and professional fees can you deduct? Attorney fees. If you hire a lawyer to draft or review lease agreements, handle evictions or disputes with tenants, assist with property purchases or closings, help with contracts or other legal matters. Accountant or tax professional fees. If you pay a CPA or tax preparer to file your rental property taxes, advice on real estate tax deductions and strategies, help with bookkeeping or financial records. LLC formation and business setup cost. If you create an LLC or other entity for your rental business, legal fees are deductible. Consulting and professional advice. If you hire a real estate coach, consultant, or a financial advisor to help with your rental business, their fees can also be deducted. Important notes, you can't deduct personal legal fees like a divorce attorney, which is not so hard to imagine. LLC fees vary by state. Some states charge additional LLC maintenance fees, which may not be deductible. Keep receipts and invoices. Always track payments for tax filing and potential IRS audits. 7. Insurance premiums. A fully deductible expense for landlords. Owning rental property comes with risks. Things like property damage, tenant lawsuits, and accidents. That is why most real estate investors carry insurance policies to protect their investments. The good news? The IRS allows you to deduct 100% of your insurance premiums. Types of insurance you can deduct. Landlord insurance. This protects against fire, theft, vandalism, and tenant-related damages. Liability insurance covers legal costs if someone gets injured on your property and sues you. This is crucial protection for landlords. Umbrella insurance, a broad, high-limit policy that provides extra liability coverage beyond standard landlord insurance. Useful if you own multiple rentals. Flood or earthquake insurance. If you live in a high-risk area and purchase separate coverage, these premiums are also deductible. Workers' compensation insurance. If you hire employees like an on-site manager or maintenance staff, their workers' comp insurance is deductible. Rent loss insurance. If your policy covers lost rental income due to a covered event, like a fire forcing tenants to move out, those premiums are deductible. 8. Property taxes. A key tax deduction for real estate investors. If you own a rental property, you're required to pay property taxes to your state and local government every year. But if you opt to pay out of your escrow accounts, then you pay monthly. The entire amount you pay in property taxes can be written off, regardless of whether you finance or own the property outright. Applies to all types of rental properties. Single-family homes, multi-unit buildings, condos, vacation rentals, and even land used for investment. Example, property tax deduction. Let's say you own a rental property and pay $5,000 in property taxes for the year. You report this amount as an expense on Schedule E. This reduces your taxable rental income by $5,000, lowering the amount of tax you owe. If you are in the 24% tax bracket, this deduction could save you $5,000 times 0.24 is equal to $1,200. That's $1,200 in tax savings just from deducting property taxes. Important property tax deduction rules. Only for rental properties. Property taxes on a personal residence are subject to a $10,000 deduction cap. Rental properties don't have this one. 9. Home office deduction. If you run your rental property business from home, whether that's handling bookkeeping, managing tenants, or doing research, you may be able to deduct part of your home expenses. The home office deduction allows you to write off a portion of your rent or mortgage, utilities, internet, and other home-related expenses, as long as you have a dedicated space used exclusively for business. To qualify, you need to meet 2 key criteria. 1. Exclusive and regular use. The space you use must be exclusively dedicated to your rental business. For example, if you use a room in your home only to manage your rental properties, it can qualify. But if you use it as both a workspace and a guest room, it won't qualify. 2. Principal place of business. Your home must be the primary location where you do your rental property work. You don't need to meet clients at your home, but if you manage everything there, it counts. What home expenses can you deduct? Rent or mortgage interest. A portion of your monthly rent or mortgage payment can be deducted based on the percentage of your home used for business. Utilities. This includes a percentage of electricity, water, gas, and the trust costs related to your home office space. Internet and phone. A portion of your internet and phone bills can be deducted if they are used for business purposes. Property taxes. If you own your home, you can deduct a portion of your property taxes based on the square footage of your home office. Homeowners insurance. You can also deduct a portion of your home insurance premiums if they apply to the business use of your home. This reduces your taxable rental income by covering part of your home-related expenses. Ideal for home-based landlords who manage multiple properties and handle business tasks like accounting, marketing, and tenant management from home. Simple to track if you keep clear records of your home expenses. Make sure to track and separate personal versus business use of your home to ensure your deduction is accurate. I know I covered a lot today, but these deductions can help you keep more of your rental income and maximize your profits. Make sure to track your expenses and work with a tax professional to take full advantage of these breaks.